Welcome to the June Economic Update. Just wanted to quickly reintroduce you to your advisory team and also let you know that behind all the advice and the information that we're giving you is a large team of analysts and a lot of client contact. Moving through, I'll let you read the asset allocation commentary, our fundamental views, and what our tactical recommendations are. Where I'd like to start this month is letting you know what you can get out of this economic update. So, we want you to understand that if we hold higher cash balances, we can take advantage of the volatility that we expect to keep coming through in this recovery phase. We're also going to reintroduce to you why we think some commodity and energy exposure is a good idea. And with all the government budgets looking at infrastructure in the US and Australia and China's own Belt and One Road policy, why some infrastructure construction exposure like building materials is a good idea as well. There are also businesses, would you believe, that are actually advantaged by the Royal Commission. We'll have an update on the long-short funds for you, an update on Europe, and we'll reinforce again why we're looking for growth opportunities outside of the ASX Top 20. The first feature piece that I'd like to have in this economic update is about dividends and why dividends are such an important component of your returns, particularly in your Australian share portfolio. Dividends are a more reliable source of returns, and we'll go into that shortly. Also, it's very important to understand that the amount of dividend that you receive is in no way impacted by a share price moving up or down. If a share price rises 10% or if a share price falls 10%, your income from that share is still the same. And it's actually this feature that applies a bit of a safety net to share prices in good dividend yielding stocks. If they keep falling and you're buying those shares at a lower price, your actual percentage dividend increases. So having a look at this graphically, what I've got on the slide in front of you is the ASX 200 in the blue line, and in the red line is the ASX 200 paying its dividends. You can see that over the last 3 years, perhaps the capital growth to the ASX 200 has only been around 7 or 8%. But when we actually count the dividends paid over the last 3 years by our top 200 stocks, those returns come up to over 25%. So it's actually the case that 70% to 80% of your returns actually come through dividends. Now, that's not going to show after 3 years just having a look at the capital balance of what your shares are doing. Those dividends are going to be sitting in your bank account. Let's have a look at that over a slightly longer term time horizon. So if we look at the ASX 200 stocks over 8 years, we can see that roughly on average, there's been about 25% of capital growth. But when we add in the dividends paid by our top 200 stocks, the returns over 8 years actually come to over 80%. So once again, 70 to 80% of your returns over 8 years has actually come through dividends, has actually come through income. And that is extremely important. So the way we look when we build portfolios for you, most of our portfolios are quite high yielding. You're looking at between 6% and 7% as a grossed up dividend yield on average. If we hold a 6% paying dividend portfolio for 5 years, we'd expect a 30% return over 5 years. If markets have had some capital gains of 10%, that's a 40% return. If it so happens at the end of that 5-year period there is a dip in markets by 10%, your returns are still going to be 20% because that income will be sitting in your bank account. that income is far more reliable than what the capital price of shares will be. The capital prices of shares will keep adjusting for whether Trump's meetings with North Korea go well or whether the view on Chinese growth is possible. But those levels of share prices will not affect the income that you receive. Your income is far more reliable. Also, understand that although the share prices are very volatile, and that's represented by the black line on this chart, so over 20 years, the average variability of share prices is 12.5% per annum, which is quite a lot. But the variability of your income is only 1%. The income over the last 20 years of Australian stocks is very low, that variability. So that is why they are far more reliable, and that is why we have them sitting in your portfolios. Moving on, a good point in time in our September 2017 economic update, the media headlines would make you think that North Korea was going to war with the rest of the world. And now, a matter of 6 to 9 months later, here we have Donald Trump and Kim Jong-un shaking hands. And we actually said at the time, ignore the media headlines. North Korea has a history of saber rattling and making large threats, but be aware that this is just political brinkmanship to bring them to the table to negotiate. And that is exactly what happened. The media creates sensationalist headlines to sell advertising space. That's how the media makes money. Political figures make sharp statements, have a lot of threat, have a lot of bluster, because they want to come to the negotiating table and hammer out an agreement. Please always keep this in mind. As we talk about that at some point in the future, it's a little bit too early to say. Both parties here, North Korea and the US, have broken promises over time. But if you're a glass half full person, please recognise that if North Korea's 25 million people is brought into the global world economy, then that means some very, very good economic things. On the slide in front of you is the South Korea president's dream of having trading borders with China, trading borders with Russia, and trading borders with South Korea. That would be a very positive economic effect, not only for Southeast Asia, but for the world. Now, I asked you to keep in mind that political brinkmanship, and we showed in the March 2018 economic update that on the position of tariffs, the US has the lowest tariffs in the world. Their tariffs are 50% lower than Europe and about 100% lower than that of China, Australia, or India. And Trump was elected on a platform to try and get a better deal for the United States. And that is exactly what he is trying to do. So once again, we're seeing threats. Once again, it's trade war. It's almost like North Korea all over again. This is political brinkmanship. Ignore the media sensationalist headlines and understand that he is trying to bring all the parties to the negotiating table to get a better deal for the states. And the whole world wants a better deal. You can see here at this particular meeting, we've got Donald Trump with his arms folded. We've got Angela Merkel. The body language looks quite negative. They are trying to come to the negotiating table to form better deals with their country. Threats, higher tariffs, that is all a part of political brinkmanship. The next piece that I wanted to present to you, in the economic updates between about 2011 and 2013, there was the Greek crisis. That looked like it was expanding out to other countries, and an acronym came up called PIGS: Portugal, Ireland, Italy, Greece, and Spain. These were the weaker constituents of the EU, and everyone was worried about their bonds. That was going to financially drag down the world, but somehow we recovered and the world has got along and done quite well. And indeed, the euro area is doing very well economically today. And still has a long way to go. What I said at that particular time was this European issue will rear its head time and time again, and it will do that because the European Union is a political structure that we don't think in its current form can last forever. And there are 4 particular reasons that I've put up there, and I just want to go through them quickly. If Australia has economic problems, our currency devaluates, our goods and services become cheaper, being a tourist in Australia becomes cheaper to a foreigner, and that helps us economically. In Europe, you've got economic powerhouses like Germany and France backing the currency. The currency will not depreciate for a weaker country. There is also only a single interest rate setting for over 18 different nations, whether you be the economic powerhouse of Germany or whether you be struggling along like Greece. In Australia, if we have economic hardship, the Reserve Bank of Australia drops interest rates and makes things easier economically, gives us some economic stimulus. This can't happen in Europe. Somehow you have to set a single interest rate for the different economic statuses of 18 different countries. That is a structure that makes it very difficult. I'd like to also skip to part 4 there, which is the constrained budget. So in the GFC, the US went into a 12% deficit, an absolutely enormous deficit to stimulate their economy. In Europe, when you sign up to the EU, you have deficit limits of only 2 to 3%. So even your governments can't help stimulate in difficult economic times. So we think one by one, European members, when they find themselves in economic difficulty, will raise the potential of trying to leave the EU, and there will be negative economic consequences, probably a lot worse than is happening from the Brexit consequence, that will keep coming up time and time again. And we do not think this is a structure that in its present form can last a particularly long time. That sort of segues quite nicely into what's happening in Italy at the moment. So Italy has elected one of those populist governments. And the modus operandi of this government is they say, hey, plan A is we stay in the euro, but we think these particular changes would have to happen. If plan A doesn't work, then we need to move to plan B, which actually considers an exit from the euro. And that is causing economic eruptions. That is causing a disorderly capital market. What does that look like? Here you can see behind me the bond yields, the 5-year and the 10-year bond yield charts for Italy. Now the 5 years up 100 to 200%, and the 10-year Italian bonds are up 50 to 100%. Let's put that in an Australian context. When I presented the May budget, I showed you that the second biggest expense item on Australia's $488 billion budget was a $98 billion interest charge. Not paying down debt, that's just our annual interest bill. If our bond yields went up by 100%, and mind you, that takes time for those bonds to roll over onto those higher yields, if they went up 100%, our interest bill would go up from $98 billion, that's $1 in $5 in our budget, to $200 billion, which would be $2 out of $5 in our budget. So when these bond yields rise, in terms of government payments, it makes large problems. Something for Italy to contemplate. But like I said, the structure of the European Union makes it economically difficult for some of the countries within there. Also, just looking in a broader context, so yes, Italian bond yields have jumped up to 3%, but we are still a very long way from the crisis events that happened in 2012. So just a little bit more context around that for you. In March 2018, I reminded everyone that our strategy team had moved us up into the next stage of the economic cycle, being the recovery phase. And I'll leave you about with the positive attributes on this slide that actually comes from that. We have a strategy for this particular phase, but I spoke before that there will be more volatility. There will be greater volatility because all the positive things about growing GDP, increased commodity prices, growing trade balances, positive purchasing manufacturing indices around the country, they have to push against now rising interest rates and rising bond yields. So there'll be a lot of positive news pushing prices up. There will be a lot of negative news and higher interest rates and bond yields trying to push prices down. We want to take advantage of that volatility over time, and that's why we would recommend that you have higher cash balances. We've also moved from bond proxy-like investments across to cyclical growth investments, and that will very much include the commodities, the energy, the building material stocks for infrastructure that we were talking about on our very first slide. So please keep a lookout for this, and please understand that we've already pre-positioned you here. But global interest rate rises and bond yield rises will be something that we keep talking about for the next sort of 2 or 3 years. Now, we're very privileged here at Morgans in that not only does every corporate head, CEO and CFO come and present to us here at Morgans at least a couple of times a year, but all the fund managers do as well. And they always raise a balanced view about what they think of the outlook for the world and what they think about the outlook for Australia. This is very different to media, so it's not a one-sided view. It's always a balanced argument that contains the good, the bad, and the ugly. And I've got that on the slide here in front of you, what the major positives are and what the major negatives are. But all the fund managers coming and seeing us all have one common feature. It's rising interest rates and rising bond yields and investors adjusting to those high yield expectations that they feel are some of the biggest risks moving forward. Why is this rising interest rates such an issue? We've actually looked back on this chart at interest rates over 800 years. And believe it or not, yes, we are at the lowest ever interest rates ever in 800 years. And we expect those interest rates to rise. Pretty much well since the 1980s, with a couple of years of a counter-trend rally, interest rates have come down. And that just sets in investors' minds that interest rates always go down, but they don't. And we think this is a turning point in history. We've had 7 interest rate rises in the US. The US is the most positively advanced economic state of our major trading partners, and the rest of the world will follow. And it's the adjustment here to these rising interest rate expectations. You can see here growing bond yields right across every time, 2 years through to 10 years. So these bond yields will keep leading interest rates up. And the Federal Reserve last week said instead of 3 interest rate hikes that they planned for this year, they are going to move ahead with 4. And this is something that we've spoken about in our past economic updates. So we have pre-positioned you. You've got floating rate corporate notes. We've moved from the bond proxies. We have been rotating to more cyclical growth sectors, as I've said before, but expect higher volatility as we go through this period. I also, in this particular segment of the economic update, look at prices, and I'm always trying to hammer home that price does not equal value. The stock exchange is a clearinghouse. The way the stock exchange clears a lot of selling volume is prices have to drop. The way the stock exchange clears a lot of buying volume is prices have to rise. And that's the function of the stock exchange. It's not a valuation mechanism. So when you see a price, that is not a value. Part of the area of the year where this gets particularly manipulated is often around tax loss selling. So in the March economic update, the first 2 charts at the top, that's redbubble.com. And I pointed out at the 30th of June in 2017, it had been sold down, but the financials and the data coming from Redbubble didn't fundamentally support that drop. And once we got through 30 June in 2018, which is the chart beside it, Redbubble had over a 100% advance. And we see this again and again all the time. The bottom two charts was the Beston Food Company, which got sold off to the end of 2017. Post-2017, it actually had quite a reasonable recovery, but seems to be being sold off again this particular year. Probably the best example that I gave in 2017 at the 30th of June was Adairs, which was a betting company, which fell from $2.40 down to around 60 to 80 cents. This was not supported by our fundamental value indicators, and in 2018, Adairs has risen right back to $2.40 again. So once again, price does not equal value. There are plenty of other opportunities here that I can get you to read through. The bottom two, once again, that was Platinum, a fund manager. Big slide in share price, not supported by fundamentals. When we came back through to 2018, we saw quite a rally in the share price. It doesn't always happen that the falls into 30th of June actually correlate to tax loss selling. This is Regis. It's an aged care provider, and it's had difficulties with government regulation, and a lot of the growth and attractive features have come out of this business. Probably some opportunities that we're looking at for 2018 now. We've seen Boral come back. That's a building materials stock that fits in with our infrastructure construction cycle. It's had big falls recently just on weather-related issues. That is not fundamental to the value of the business. We see good opportunities there. We also see good opportunities with some of the international fund managers. I'm going to go into that a little bit later. So looking at the Royal Commission now, the blue line is the ASX 200 indice. The other four lines are banks. They have depreciated in price between 7 to 15%. International institutions would be concerned that regulation is coming into the Australian banks, which makes their future revenues and profits risky. The view of our analysts is that the regulation coming from the Royal Commission won't be too damaging to the bank's underlying profitability at all, and this has been overdone. But you can see the key dates there of the interim report at the 30th of September, and the final report coming out in February 2019 means we still have some time to go before this Royal Commission finishes. But there are beneficiaries to this Royal Commission. Those particular fund managers, you can see up there, the Platinums and the Magellans, they don't have vertically integrated price models, and we don't think that they'll be affected. There are also some platforms out there that are independent to the advice or the investment that people are buying, and we think that they'll do very well. Just coming through to our discussion on major economic blocks. So synchronised global growth looks exceptionally good around the world. That's part of the positive forces pushing prices up, but rising bond yields and rising interest rates, they are the volatility triggers that will keep knocking markets down. Please keep that at the back of your mind. Understand that in the US, earnings of US businesses are at the highest levels ever. That is exceptionally positive. Also in China, their economic growth models there are going very well. They are transitioning to a consumption-led economy, and that is going very well too. Their environmental policies are looking at shutting down smaller inefficient mines and smaller inefficient industrial production. You can see some of the electricity generation dropping back and the cement production dropping back. That is consistent with their environmental policy. They still need the materials and the energy supply to get the energy flow and continue with their construction program. They are looking for that from overseas trade, and that's been very positive for commodity prices, as we showed you in March. Europe is moving along quite well. It's still economically well behind the US, but we do think there's a lot of room there for capacity expansion. So interest rates aren't coming for the European Union for quite a long time. We think that's a very positive place for investors to put some monies. Back here in Australia, very robust growth that's coming through. Our unemployment sitting at 5.5%. We still have a lot of room for capacity expansion, and we do not believe that we'll see interest rate hikes until the last quarter of 2019 now. Business confidence very strong, consumer confidence very strong, and businesses are starting finally, these are the non-mining businesses, the light blue line, are finally starting to invest in expansion capacity here in Australia. And we also think that public infrastructure construction is going to be very good economically and for jobs as well. I did record those budget implications. I think that's very interesting for you to have a look through, and I've just given a copy of the video recording there. But basically, the increase in commodity prices had led to $35 billion extra dollars sitting in Australian government coffers that they hadn't planned on 8 months ago. And we think the strength in commodity prices there will keep happening. You see those planned infrastructure building charts there in Australia. This is going to lead to huge demand for building materials. And a lot of those building materials are going to come domestically out of this country. Don't forget a company like Boral too has a lot of building materials in the US, where there's also a massive infrastructure plan going on. Looking quickly at global indices, Australia there in the blue, Germany in the green. Over the last 12 months, not much growth at all. Probably the best markets over the last 12 months have definitely been Japan and the US. Looking at the 3-year chart there, you'll see China underperforming. It's quite an immature capital market and had a big collapse 3 years ago. But you'll see the best market there is by far the US. And that's very consistent with our economic presentations on how well economically the US is actually doing. So we do expect Europe and Asia to continue to catch up from here. It's another point that's worth noting is it isn't just the recent Royal Commission that's been pulling the bank share prices down. The banks started coming down from about 3 years ago. So extra capital, extra regulation, extra focus for the banks makes it hard for them to continuously increase profitability and dividends. And we do think that's an environment that they will have to deal with for quite some time. We don't look at banks as growth stocks. We look at banks as income stocks. I did promise that we would have a quick look at the Australian top 20 in the blue line versus the mid caps in the red, small caps in the brown, and micro caps in the green. If you want growth from your Australian portfolio, you have to move some of your investments outside the Australian top 20, where we don't see a lot of growth. Good yield, but not a lot of growth. I want to look at US currency, and our medium-term view is the US currency will get weaker and the euro will get stronger, and that is purely that the US is looking at going back into big deficits with Trump's infrastructure construction program, and that Europe is moving to surplus. I won't go into this economic update, but the euro getting stronger and the US getting weaker is exceptionally good for commodity prices. Oil, we are very positive on. That drop to $26 a barrel, you can see in 2016, shut down a lot of oil expansion programs. BHP, when it reported to us recently, said they expect higher prices for oil 2019, 2020, 2021. With commodities here in Australia, not only are we seeing export volumes increasing, but we're seeing the prices go up as well. Very, very good for commodity stocks, and that's why it's a strong part of our investment thesis. Model portfolios there, returns for you to read in your own time, and that brings us through to a quick discussion on fixed interest. I've got a link here. It's an educational link on fixed interest. Please have a look. The main point that we've seen in the last little while is there has been a tick up in global credit spreads. That's the final little tick up that you see in that chart in front of you, and that has caused a pullback in some of our major bank hybrid instruments. They've probably pulled back from February around 3% or so. That tick up has seen issuance move on from the 3.4% margin that the Commonwealth Bank was offering to the latest issuance by Macquarie Bank at 4%. Because that Macquarie Bank note will pay 0.6% more than the CBA note for the rest of its life, the Macquarie Bank note will trade a bit higher, and some of those older notes at those low 3 margins will trade a little bit lower. That's all we're seeing there. Other than that, we find that our notes are trading very well. Many of them are still trading at premiums, and there's no more note issuance coming out until we get to about December of this year. So there'll be a lot of buying support for our notes coming through. So our 2018 outlook remains very similar to that which we set in March. I'll leave that for you to read. And just coming back to our action items that we wanted you to get out of this economic update. There will be volatility, the push of high interest rates and the tailwinds coming from better economic times and higher company earnings. Maintain large cash balances. Let's do some buying on the dips. Commodity and energy exposure, very positive. Building materials exposure, very positive with these infrastructure construction booms. The fund managers, particularly the global ones, will actually be a very positive outcome from the Royal Commission. I'll leave the long-short funds for you to read in the attached notes that I sent you last week. European exposure can expand. Businesses there can get increased profits. There won't be interest rate rises for some time. And if you want growth out of your Australian share portfolio, it will definitely pay to look at the smaller end. Just remember too, when those volatile periods come through, sometimes we don't have a long time to act and we'll need to move quickly. Thank you.